Welcome back, everyone. Wanted just to let you know what we're going to be doing today. We're actually going to be getting a lot more accomplished in terms of the 1040. If you recall, the first couple weeks we have talked about areas such as dependency issues, filing status. So really just covered kind of the top part of the 1040 that you see in front of you. Last time we met, which was right before Thanksgiving, we had talked about income, getting us all the way down to line 22 on the 1040. Good news is tonight we're going to complete both pages. We're actually going to get through all of the income tax return tonight and show you exactly the next steps in the entire process. The nice part about tonight is we're going to be telling you a little bit more about some of the adjustments to income, some of the deductions, and some of the credits that we can have for our taxpayers. So last time we met, we were talking about all the things the IRS can tax. Tonight we're going to start taking away those taxable items and hopefully reducing our client's income that is subject to income tax. So what we're going to be covering tonight is first starting with what we call the adjustments to income. We're going to start with our total income off of line 22, and we're going to start making a couple adjustments to those items. And a lot of these are going to be based on taxpayer facts and circumstances. The nice part about these adjustments to income is that these are available to any taxpayer who qualifies. You don't need itemized deductions. You don't need any other special process. If you meet the requirements under these adjustments to income, they can automatically reduce your taxable income. So a couple of things that we're going to talk about. These are going to be found on lines 23 through 35 on your tax return. Not all of these will be applicable to VITA, but we'll just cover the top salient points. The first one we're going to cover is education expenses. So these are going to be for anyone who's in the education field, anyone who's teaching from a kindergarten through 12th grade level who has at least 900 hours of employment. What we have is the opportunity for those educators to deduct $250 on the income tax return, which we consider an adjustment to income. They don't need to have unreimbursed employee expenses. They don't need to itemize deductions. They're eligible to take up to $250 on the federal return. So the question is, who do we consider an educator? And that's really anyone who's a teacher, an aide, a counselor, an instructor, a principal, or anyone who works in a school system, again, K through 12. Homeschool, unfortunately, does not count. So if you're educating your child at home, you are not eligible to take these expenses. However, if you are an instructor for a cyber school, you are allowed to take this $250 deduction. What we're looking at here is it's going to be the lower of the costs actually incurred or the $250 level for any supplies or materials needed to help the education process. So that could be books, supplies, any type of equipment. That includes any type of computer equipment, any software, any programs, any apps that might go with it. Those would all be part of the process. Anything that can help enhance the classroom experience would be considered an educator deduction. If they have an amount greater than $250, we can take that excess amount on the Schedule A as a miscellaneous itemized deduction if they qualify. Most cases in VITA they will not. But the important part to note when we talk about state taxes next week is that we do get a deduction against your wage income. There is no $250 limit for educators. They can take as much as they've incurred. So if you have someone who comes in and they're a teacher and they say, I've heard in the break room that we can take $250 off the return, please go ahead and do that for me. We would still like to ask, how much did you actually incur? How much did you have in those education expenses? Because we can actually take the full amount on the PA return, and any excess amount may be eligible for an itemized deduction. Couple interesting rules. And we'll talk about some application with the tax code process here. In general, almost any educator qualifies. Again, we talked about principals, teachers, aides, instructors. There's an exception for health and gym teachers. I'm not quite sure which senator had a problem in high school with their health and gym teacher, but they've narrowed the ability for them to take the educator deduction. So actually, a physical education and health instructor may not take any of these qualifying expenses if they're non-athletic supplies. So they can't actually hand out any other additional materials unless they're related to athletics. So if they're purchasing equipment for athletic purposes, that's fine, but non-athletic, they can't put up a bulletin board in health class like a teacher in English or physics can. So just a slight restriction that you may need to double check on. Other thing we just want to watch is that if there's any reimbursements coming from the school or an education savings account, those would reduce the amount of eligible expenses. However, when we see what's happening with the state budgets, more and more schools are losing some of the funding for teachers, so we're seeing more and more educators providing their own supplies in connection with the classroom materials. So if you see someone with a W-2 coming from a school district or other type of institution, K through 12, you may just want to ask if they have any expenses that could qualify. And again, they don't need itemized deductions, which we'll be talking about probably in about 17 minutes, if all goes to plan. Okay. Any questions on the educator expenses? Those would just go in TaxSlayer. They would automatically populate on line 23. So they are in what we call the adjustments to income. One of the other areas that we may see on occasion, not often, oh, I'm sorry, yes, sir.
When they come in when we're interviewing somebody going through the return, they need to have receipts for that?
They technically would need to have receipts for substantiation for their own return. We can simply ask the question, what were your educator expenses? So we don't need to see copies of everything that they've done. We can generally take the taxpayer word on some of these areas of expenses and other items of deduction. It'd be great if they bring it in just so you can verify that they have it. But what probably a good point is, if they bring a whole lot of receipts in, if they bring a big stack of things and say, I went to the supply store and here's what I have, we don't really want to go through and add them up for them. Kind of takes up a lot of time in our process. So if you see someone coming in and they've got a giant crate full of stuff, probably the best thing we can suggest, and hopefully some of the site coordinators can attest to this, is probably give them a nice spot in the corner to go ahead and add up some of their items or ask them to come back a little bit later. But if they do bring a list and say, here's my acceptable expenses, we can go ahead and use that information. We don't actually hold on to anything in VITA, so we return all the documents back to the taxpayer, and we probably do want to remind them of substantiation requirements that the IRS may ask for. So it's always a good idea to hold on to your receipts. We don't actually need to go ahead and tally them for the taxpayer, but we do suggest that they hold on to them. All right, good question. And we'll probably get to that a lot when we talk about itemized deductions, people who bring in some receipts and ask if they can itemize deductions. And we'll give you some tips and techniques of how to make that work more effectively. All right. So if you had any questions with the educator expenses, that's on tab E2 of your 4012, if you wanted to follow along in your materials. One of the other deductions we may see, I know in our morning class on Tuesday, we had a couple people that have seen it throughout their VITA process. I don't think we see it all that often. Howard, do you see much alimony deduction?
I think we see one number before.
Okay.
And we do have some clients who have the alimony in there.
Okay, all right. So one of the areas that we take a look at, we had talked about income 2 weeks ago, and alimony is one of those items of income that has to be reported on a federal return. So the nice part about the IRS matching program is if someone has to pick an item up as income, generally means someone else gets to take a deduction for it. And that's what we're looking at when we talk about alimony deduction. So if you are required to pay alimony, and generally what we're looking at is payments made under a divorce decree. So once you're actually divorced and the payments are made from a spouse to a former spouse, the payor spouse actually gets a deduction for those amounts, provided they meet certain requirements. So some of the things we have to take a look at is the recipient and the payor cannot file a joint return, which would be pretty difficult if you're divorced. You're no longer married, so you shouldn't be filing a joint return. The payment has to be in cash. And checks do count as cash, Bitcoin counts as cash, just can't be made in other types of property, so it has to be a cash payment. One of the other things we like to point out is the ability of the IRS to not comprehend the English language. You'll find an area here where we have a double negative. So the payment cannot be designated as not alimony. So we kind of negate the negatives there. What we're basically saying is the statement has to basically say it is an alimony payment. We can't have the agreement say this is specifically not alimony. Personally, whoever had a problem with the gym and health teachers must have also had problems in English class writing the tax laws here. There'd be a better way to phrase out than double negatives. But we can't have the agreement state that the payments made in cash are not alimony payments. If that's what the agreement says, we can't take those. Now, the benefit we have is that we do not have to read and interpret a divorce decree. Usually the taxpayer coming in will know based on conversations with their attorney, whether it's from the judge or whether it's from the mediator who had settled the process, how much is an alimony deduction. so we don't have to read the agreements. If there's any type of question about how much is alimony, we're going to have to refer them back to either the court or their attorney to figure out how much is alimony. We can't go through and determine that process. The interesting part is that whatever is put down on the return as an alimony deduction, we also need the recipient spouse social security number. The reason why we need that is because the IRS likes to have that as well. Because what will happen is we'll see a deduction on one person's return, reporting an amount of alimony and the social security number. The IRS is very good at matching things. So they will eventually catch up to a return and see, did that social security number of the recipient spouse report that exact same amount as alimony received on line 11 of their return? So we do need to have that information. Other questions we may just have is making sure the spouses don't live together. Again, that's kind of an odd concept that you're paying alimony and they're still living together, they're still technically married, which can't really happen. Some other requirements are that the payments have to end upon the death of the former spouse, so they can't go in perpetuity. The other interesting part is that they cannot be considered child support. So if there's any allocation to a child, that is not part of alimony. So if someone says, I'm paying $2,000 per month, I want to take $2,000, and you ask, well, is any of that child support? Well, $1,000 of it's for the children, and $1,000 is for my former spouse. Well, then the deduction is only $1,000 a month. It's not that $2,000. And the interesting part about child support, it may be written in the agreement to determine at the age of a child. So it may be saying that the payments will change from $2,000 a month, and in 2025 they're going to go down to $1,500 a month. 3 years later they go down to $1,000 a month. What they're basically doing is backing into birth dates, or if they're referencing graduation from high school or college. If there's a change in payment, it's typically going to be a child support component. Alimony typically does not change once it's set. It's usually for a period of time or until death of the spouse, whichever comes first. So we do see these on occasion. In most cases, hopefully when they came in, did they know how much they had in alimony? So you didn't have to do any legal research and determine how much that amount was. All right, but they do need to have the spouse's social security number, a former spouse, just to be able to match up the process. If we do have that, it's a very simple allocation within TaxSlayer. We just need to know the amount of alimony paid and the spouse's social security number, and they will show up on line 31. All right, another opportunity we have for adjustment for income, which again we may or may not see all that often, would be any contribution to a retirement account started by the individual. These are individual retirement arrangements, or IRA accounts. So an IRA allows an individual to go ahead and put money into their own retirement fund. There are some opportunities that you have in order to go ahead and defer some income and treat this almost like an employer-sponsored plan. When we talk about employer-sponsored plans, 401k, 403bs, what you're doing is you can defer money from your own salary into a retirement account. So from a tax perspective, we don't pay taxes on those contributions, but as we talked about last time, you do pay money on those when you take them out of your retirement account. The individual retirement arrangement works the exact same way, only instead of going through an employer, you can actually establish this account through any local institution. So you can go to a local bank, they can establish an IRA, you can go to an online service and establish an individual retirement account as well. If you establish one, we may have the opportunity for someone to take a deduction. So as long as you haven't reached the age of 70 and a half by the end of the year, as long as you have some sort of taxable income, and generally that's going to come from wages or self-employment, there is a little caveat. Compensation for purposes of IRAs also includes alimony and any amount of taxable scholarships. So if you have any taxable scholarships, that will allow you to take an IRA deduction. So if someone contributes to an IRA and you have to make that contribution by the due date of the return, which for the 2017 filing season happens to be April 17th, 2018. And some of you out there are saying, wait a minute, I've always known the tax deadline to be April 15th. What happened? Okay, so what happens is April 15th this year happens to be on a Sunday. Okay, so we get that part. So April 15th would go to April 16th because the government doesn't work on Sundays. So due date should be April 16th, right? Except for the fact we actually have a holiday in the District of Columbia called Emancipation Day, which means the Internal Revenue Service is not operating that day. In addition, there's Patriots Day up in Massachusetts, which forces a closure of the Andover, Massachusetts Center. So because we have a federal holiday and a state holiday, we actually move our due date to April 17th, which is a Tuesday. But don't worry, I don't think Ezra's going to have you sign up for Tuesday shifts on April 17th for any last-minute taxpayers. So we're usually wrapped up the week before. All right. Depending on certain sites. All right. You do, okay. All right. So still open on the last day?
Still the last day, it's always crazy.
Okay. All right. So if you haven't signed up for a site yet, you know where the crazy sites are. All right. Okay. So you do have up until the due date of the return, April 17th of 2018, to make that contribution. And that actually allows you to take a deduction on the 2017 return, even if the contribution were made in 2018. So what we're looking at, there's some limitations. You can deduct up to the lesser of either $5,500 per taxpayer, or if you're age 50 or over, you get another $1,000, so it goes up to $6,500. But it's that amount or your taxable compensation, whichever is less. So if you have a part-time job and you're making $4,000, you can contribute up to $4,000 to your IRA, not $5,500. If you earn $10,000, you can still contribute up to $5,500. If you're over age 49, you contribute $6,500. There are some opportunities. Depending on spousal situations, you may be able to take a spousal IRA. They can use the spouse's taxable income and contribute to an IRA. We sometimes see that in terms of some of the returnings. Do you see a lot of IRA contributions? Seen them on occasion at all? Okay. So we may not see a whole lot of these throughout the season, but if someone does ask, we do have the opportunity to take an IRA deduction. And that would be on E7 with some additional information. There are some limitations if someone is covered by a retirement plan at work, and you'd actually see that on the W-2. There are a couple check boxes right next to usually box 12 or box 14 that'll have 3 different classifications. If they're participating in a retirement plan, a code D or code E is automatically going to check the box that they're participating. If they're participating in an employer plan or eligible to, they may be limited in the amount of an IRA contribution. Again, we may not see that very often, but we do just want to point this out. Yes, question?
For the contribution that was made by the due date, if they're filing early, can you just take their word that they're
Sure. Yeah, that's a great question, because the question is they have up until April 17th of 2018 to make the contribution. If they're coming in the site early and they say, I will absolutely make the contribution, you can take their word for it and say, we're going to prepare the return, but you need to make that contribution by April 17th of 2018. There's a fairly substantial consequence for not doing it, because the IRS will come back, and if you did not properly fund your account, they can charge you penalties and interest for basically taking a deduction you weren't entitled to. Same problem if someone over contributes to an IRA. If they contribute more than the allowable amount, hopefully we can have them withdraw the amount before the due date of the return. So if they went and they contributed $10,000 to their IRA, first of all, they probably should look for a new IRA provider, because they should know you can't contribute more than the $6,500. But if they over contribute, you can take that money out before the due date of the return and minimize the penalties. Usually with our clients, we have the opportunity to ask for forgiveness quite a bit from the IRS. But we can take their word to say that they are going to contribute. Probably you want to remind them very substantially that they need to make that contribution. New this year, we are rolling out basically an information sheet for the clients, basically to go through some filing instructions. So it'd probably be a good point on there to write in probably a 48-point font. Go ahead and make your IRA contribution by April 18th, or 17th, yeah. Sure. Yeah. If and again, we don't see a whole lot of people walking in who have less than $62,000 of income and say, I'd like to fund my IRA. But in case they do, hopefully they have the sophistication to know to make it on time. Yeah. Great question, though. Okay. So that would be on E7 of the 4012 if you have additional questions on the IRAs and how they would work. One thing that we do see more frequently is actually student loan interest deduction. So student loan interest allows taxpayers to deduct the amounts that they're paying on qualified student loans. So this would be the interest component on those loans. And that applies if the loan was either for the taxpayer, the spouse, or a dependent at the time that the loan was taken out. So that allows a parent who is a guarantor or co-signer on a loan to pay student loans and take a deduction for the interest, as long as at the time the loan was taken out, their student was a dependent on their return. The main thing we have to take a look at it is to make sure that the person who is taking the deduction is legally responsible to pay the debt. If you're not legally obligated to pay the debt, you may not take the student loan interest deduction. A couple other qualifications: the loan has to be paid within a reasonable amount of time. In most cases, student loans will not let you go too far before they catch up to you and let you know that you owe money. So that's usually not a problem. They also have to be taken out for eligible education purposes, meaning you're at least a half-time student. The deduction levels that we have is either the amount of interest paid or $2,500, whichever is lower. In most cases, we're not going to bump up to a $2,500 threshold within the VITA program. I have seen it in practice, not through VITA. Actually, I had a client who went through medical school, took out student loans to pay for all 8 years. His interest expense on the student loans is quite substantial, almost as much as our VITA limit for income. When you're talking about $750,000 of student loans, quite a bit of interest. We do not have that here in VITA, so fortunately we don't have those limits. One issue that we do have is we talked about filing status a couple weeks ago, and we said, what status do we probably not want to have our clients try and file? Married filing separately. And now we get to the part of our training where we say, why do we not want them to be married filing separately? They file married filing separately, they cannot take student loan interest. This is the lightest of the ones we're going to talk about tonight they're not eligible for. So if they file married filing separately, they cannot take student loan interest. They also cannot be claimed as a dependent on someone else's return. So if you have a student who's obligated to repay and they are repaying, if they're on someone else's return as a dependent, they may not take student loan interest. And again, just a reminder, you have to be legally obligated to pay the loan in order to take the deduction. So if a grandparent would like to pay off a student loan or make payments on behalf of the student, they're not eligible to take the interest. The grandparent cannot. However, it can be deemed as a gift, which would allow the student to go ahead and take those interest deductions, provided they are not claimed as a dependent on a return.
How does that handle with a plus loan? The parent took out the loan?
Sure, if it's a plus loan and the parent is legally obligated to repay the loan, then they may take, the student loan interest.
Pay the student.
The parent may, if they're legally obligated to repay the loan. If they're on the loan as a co-signer, or they would be allowed to take the student loan interest. Now, the interesting part that can happen is generally the form that you'll receive is a 1098E, which we'll show you an example in just a second. But generally, a lot of the forms that come from the IRS, or come from basically IRS forms coming from a institution, will only list the first person on the account, list their name and social security number. Usually they don't put more than one person down on the account. So you may have to ask if someone comes in and says, I have a 1098E, it happens to be in my child's name, but I'm paying the interest. Just be sure that they're legally responsible to pay that debt. If they are, then they should be allowed to take the interest. Okay. Yes, question?
What happens if they pay off the loan for a time? Is that
Well, if they pay off the loan, what we'd see is that there's going to be some element probably of interest associated with it, but they've completely paid off the debt, so they will no longer have interest on the note, so it just won't be continuing in the future. But we won't really get an indication on the 1098E that the loan is paid off, if that's what you're asking.
I know, I just don't know how to, like, if you claim the interest of that.
Yeah, so you'll get, and actually what we'll get here is a Form 1098E. Usually the taxpayer will bring that in. And our example, we have a college up here. Usually the colleges don't lend money. It's going to be coming from either a government-based institution or maybe a third-party provider, AES or one of the other providers of student loans. But what you'll get is a 1098E. And fortunately, these forms are fairly easy to work with, because there's really only one box that has any relevant information other than the taxpayer identification, and that's the amount with a dollar sign. So that's the amount of student loan interest you'd have for the year. So if you're paying off student loans, if really any type of debt, part of it's going to be the amount that you borrowed, and part of it may be associated with interest. So the 1090-80 is always going to show you the amount of interest that was paid on that debt. So even if they paid off the entire loan in 1 year, if there's any element of interest, that's going to show up in the 1090-80 with that dollar sign.
Okay, so that's automatic.
Yeah, so we don't have to do any calculations with that. They'll actually get that from the provider, and we can simply enter that information in on the 1040. Now, the nice part is about the student loan interest is the amount that qualify for education purposes happen to be tuition, fees, and it actually includes room and board. So if you're taking out student loans to help pay for student housing, student meal plans, those are all eligible expenses for student loan purposes. Now, we'll take a look and see how the IRS will use similar names but different definitions as we go through the rest of the night. Things that change, like definition of a child, definition of education expenses. Yes, sir?
We have the application inform clients about repay or income-based repayment programs.
We don't usually get into that within VITA. Typically, there are some areas that we can refer them to for financial assistance if they need to take a look at student loans. Often you may get someone who talks about, I'm having a hard time paying student loans, or I may go into some sort of either default provision or some sort of deferral. There are services we can refer them to that will give that type of financial help, but we typically do not provide that within the VITA context itself. So the question is basically helping them out with student loans and talking about some repayment areas, particularly repayment based on income and other factors along those lines. Yes?
Looking at your club note here,
Yeah.
proceeds, what club is that listed out there? Because it's kind of different, can be confusing when someone's looking at the American Exchange credit.
Sure.
So that last bullet.
Right.
What club is that reference?
That'd probably be in Pub 17, would have that information in. In addition, we'll probably see some information within the 4012 on E8 that'll give you some additional reference. So it's the point that we're looking at here is that the education expenses include room and board in this context, and they will not for purposes of the education credits. Yep. Okay. Any other questions with student loan interest? Generally, if they're going to bring a 1098-T in, we're just going to look for that one number, make sure that they're legally obligated to repay the loan. And if that's the case, we'll simply enter it in a tax slayer, and that'll populate on the return right on line 33. All right, one of the other things we do want to talk about kind of with education, there's actually a spot immediately beneath student loan interest, which is called a tuition and fee deduction. And this information is on your 4012 tab J. Kind of covers the tuition and fee deduction. We do want to start off with a caveat to say you probably will not use this in the VITA tax filing season, because most taxpayers will qualify and usually receive a tax credit instead of a tax deduction. And when we talk about the difference between deduction and credit, a deduction is going to reduce your taxable income dollar for dollar. So whatever it reduces still has to be multiplied by a tax rate. So if we think about a taxpayer coming into VITA, if they're in a 10% tax bracket, a $4,000 deduction at most will give them a $400 benefit on their return. 4,000 times 10%. If they're eligible for a tax credit, that credit's going to reduce their tax liability dollar for dollar. So a credit is always going to be more powerful than a deduction. So we don't often see the ability to use the tuition and fee deduction on a return. There are some rare exceptions where if a taxpayer does not qualify for the American Opportunity Credit, and we'll talk about that one in just a little bit, and the lifetime learning credit doesn't provide as much of a benefit, perhaps the tuition and fee deduction can help because it actually does reduce your adjusted gross income. So if you get in that situation, again, I've only seen it a handful of times, but generally we'll take a look at having the credit instead of the deduction within VITA. So what we're looking at here is the ability to deduct up to $4,000 in qualified tuition and related expenses. So the first thing we need to take a look at is who qualifies for this deduction. And again, that's going to be either the taxpayer, the spouse, or a dependent on the return who attended an eligible institution for that current year. And an eligible institution is basically an institution certified by the Department of Education as a qualified institute of higher learning that leads to a degreed program. So the institute itself will know whether or not it's approved by the Department of Education. So if it is a surfing school in Hawaii, that you get a certificate of completion at the end, printed out by a guy with long hair and braids. That's probably not a qualified institution. If it has college or university next to it, it probably is a qualified program. If they can go ahead and issue student loans, that would be an opportunity for qualification with Department of Education. A couple rules of eligibility. Guess what? You cannot file married filing separately and still take the tuition and fee deduction. So again, we'll see it another time here or two, why married filing separately is not a great status. You also may not take this if you are dependent on someone else's return. Generally, if you are dependent on someone else's return, then the parent will claim you, and they can actually claim the tuition and fee deduction instead. So what do we mean by qualifying expenses? When we talked about student loan, we talked about tuition, books, room and board. What we're talking about for the tuition and fee deduction actually changes, and this definition will carry over when we talk about credits. When we talk about qualifying expenses for tuition and fee deduction, it literally is tuition and fees. Sometimes the IRS is very confusing when they talk about things, when they define items. In this case, they pretty much told you exactly what they're looking for: tuition and related fees and expenses. Room and board does not count for these purposes. Room and board is considered personal living expenses. Students need to eat, they need to sleep. So because all humans need to eat and sleep, they figure there's not a availability of a deduction for eating and sleeping costs. So room and board are not part of the education costs for purposes of the deduction or for the credit. So that would be any type of insurance, any health insurance they may have, any travel back and forth to school is not considered an education expense. Those are personal expenses. So if somehow your surfing school in Hawaii is a qualified institution, you cannot deduct the cost of flying out to Hawaii for your surfing school. You can take the cost of tuition and any related fees, just not room and board and not travel. All right. So again, what we're going to take a look at here, generally we'll find that the education credits are going to be much more powerful and much more popular than the tuition and fee deduction, but that is an option out there. So just want to point that out to you. Okay, so what we'll do is we take a look at all those adjustments. These are, again, are opportunities taxpayers have. It doesn't matter if they take a standard deduction or itemize their deduction, they're eligible to take these and reduce their taxable income dollar for dollar. So that would allow us to have an adjustment. So we'd see any of those items automatically totaling in line 36. What we'll see is line 37, which is going to be considered our adjusted gross income. And that's really the kind of number that a lot of people reference. What's your adjusted gross income, or AGI? And that is going to be, in this case with the HEST return, $31,977. What we'll see is that's the number on line 37 that'll carry over to the second page of the return and populate in line 38. So this is the amount that we're going to be starting with. This is essentially the total amount of income that's going to be subject to tax. But now we walk into the provision of having the opportunity to reduce that income. So one of the things we had talked about in the very first week was understanding personal exemptions and dependency exemptions. Those will come into play. Those will allow us to reduce our adjusted gross income before we get to taxable income. The other situation we have is the very next line, on line 40 here, is taking either a standard deduction or an itemized deduction. What we mean by a standard deduction is the IRS allows every taxpayer to take a standard deduction based on their filing status and their age. So the standard deduction for single taxpayers is $6,350. For a married couple, you double that. So in this case, it's actually going to be $12,700. Why these numbers are important is because we have the ability to potentially itemize deductions. So you usually get the benefit of the higher of the two numbers, either a standard deduction or an itemized deduction. But before we spend a lot of time going through and asking taxpayers, do you have itemized deductions? And they say, oh yes, I had a lot of medical expenses, and I gave a lot of money to charity. What we're looking at is they have to be higher than those standard deductions that the IRS will provide for us. The nice part is TaxSlayer will automatically give us the highest amount. So we don't have to go through and calculate that manually. The only situation we have that we may not have a full standard deduction is one particular filing status: married filing separately. If you're married filing separately and your spouse files and takes itemized deductions, you are required to itemize your deductions. So you no longer get a standard deduction. You have to add up every single itemized deduction that we'll show you in just a minute and figure out what your deduction from income will be. So that's another detriment. If we needed any more, we'll throw a handful more out tonight. But if you needed any reason not to file married filing separately, we're going to give them all to you tonight. So what do we mean by an itemized deduction? How do we get this magical ability to take more than the standard deduction? And there are a couple areas that we're going to take a look at. The common ones within VITA, we'll actually kind of skip over the first one for now because we'll talk about that in a little bit more detail. The main area that we're going to see people with itemized deductions are coming out of home ownership. And we have a great section within the 4012 on F3 that talks a little bit more about itemized deductions and how we calculate those. But for the most part, the majority of individuals that itemize deductions within VITA are homeowners, because you can deduct your home mortgage interest. You can deduct your real estate taxes, and you can still deduct any PMI or mortgage insurance premiums that you have with your loan. Those are all considered deductible expenses. So what we have talked about is we need to get over that standard deduction threshold before we get any benefit from itemized deductions. So for a single individual, $6,350. Married, $12,700. It's a little bit difficult to do that within VITA based on some of these other areas. You do get to take state and local income taxes. So the amounts that you have withheld from your wages that you have for PA and for local become a deduction for Schedule A. If you itemize, we do suggest you take a look at the W-2 because those other taxes of employment, the LST and the PASUI, are also deductible taxes. Certain individuals, if you do not have a state or local income tax, may take a sales tax deduction. And you can go through and calculate that for tax layer. But it's going to be very difficult for most of our taxpayers to get over that amount, the $6,350. If you're blind or you're over the age of 65, your standard deduction goes up even higher. So I think, Howard, you probably at your site see a good amount of people that have the blind exemption? Okay. Okay. So basically, if they're blind, we mark that in the front page or the front part of the intake, and it'll automatically increase the standard deduction. So if they're over 65, they have a higher standard deduction. If they're blind on top of it, deduction goes up even higher. So if you have an elderly couple coming in, both over the age of 65, their standard deduction is well over $12,700. So we just want to make a point to say, before you spend a whole lot of time going through, and if someone brings in a bunch of receipts and said, I had a bad year medically, I think I spent about $400 in medical expenses. I had to get new glasses, I had a toothache really badly, I had a lot of medical expenses. Medical expenses on their own generally will not get you to an itemized deduction, and the reason why is because the IRS puts a limitation on them. So for 2017, we need to get over 10% of your adjusted gross income. So if your adjusted gross income was $40,000, you need to have more than $4,000 in medical expense before you get any benefit. So you need $4,001 of medical cost to get $1 of itemized deduction. So if you're single and you're under the age of 65, you have $1 in itemized. You only need $6,350 more dollars of itemized deduction to get any benefit. So we generally do not see medical in and of themselves creating a itemized deduction. That may change if you see someone who's in a nursing facility. If someone has skilled care, what will often happen is the community will give you a statement to say how much of their cost is related to medical expenses. So particularly for someone who has not full function to be able to feed, clothe, medicate themselves, bathe, if they're getting assistance, part of that nursing home may be considered medical deduction. So that could come into play. Some other things that we see would be gifts to charity. Again, most of our clients coming into VITA will not get over the standard deduction just by giving money away to charity. I don't know if anyone's seen that yet, where someone's given away a lot more of their money, but even when you consider tithing, somewhere between 10 and 15%, we're not going to usually get there based on our VITA clients. Just as a reminder, the IRS will take a look at charitable deductions fairly closely. They do have some substantiation rules. So if you give more than $250 to a charity, you're supposed to get contemporaneous acknowledgement from that charity, meaning it's written down. to say you had provided the following either items or check or cash or whatever the item may be with the date acknowledged by the charity. So the IRS is going to want to see that in case of audit. Again, we don't audit the clients, but we do want to remind them of substantiation and documentation rules. That would be found on F13 of your 4012. Just be able to remind them of what they need and what to hold on to. So gifts to charity. If it's under $250, you really don't need the substantiation, but you do need to try and come up with a list of record. So if someone says, I drove through Lancaster City and the firemen were out there with their boots and I put $5 in the boot, that's fine. You can take that as a deduction. The money has to go directly to charity. It can't be going through a non-charitable entity. So if you decide you want to sign up for a 5K race and they say they're going to benefit a children's cancer fund, unless it's being run by a nonprofit organization, that is not a charitable deduction. If you go to a restaurant and they say we're going to donate 10% of your food cost to charity, that's not a deduction for you. They're not a charity. So it has to go directly to a charity. So just some things that we need to keep in mind. So when you're there at the checkout counter and someone says, would you like $1 to go to charity? You have to make sure that it's actually going to that charity itself. Better to go and give it to the bucket outside in the mall to get a deduction for it. Okay, any questions on kind of general overview with itemized deductions? Yes?
Are there any circumstances that you separate from your spouse and haven't seen the same income or if they're dead or alive? You're still obligated to file the test?
You're technically responsible to file married filing separately. That's the IRS definition because you're still married as of the end of the year. In practical purposes, we take a look and see how they've filed in the past, but technically you're to be filing married filing separately. Unless they have a qualifying child and maybe could be head of household and considered unmarried. But technically if they do not have, if they don't know if their spouse is alive or dead, might be a good time to do a Google search and see if you can find them. But if they're not divorced, they're considered married and would technically have to file married filing separately. So just an unfortunate consequence of the tax code. Okay. So again, with itemized deductions, most people are probably going to know whether or not they itemized. A good kind of test is to see if they brought in their prior year return and if they itemized in the prior. For the returning volunteers, have you seen a lot of clients that have itemized without having home ownership? Unless they were in a nursing home or had an extensive amount of medical expenses. Generally, that's going to be our first trigger. So they might be bringing in a Form 1098. And a Form 1098 is going to be coming from the mortgage company. It's generally going to show how much they have in mortgage interest, also if they have any mortgage insurance premiums, and if potentially they had real estate taxes paid through escrow. Just a couple other interesting issues on the medical expenses, though. So if you do qualify, you actually can take medical expenses for the taxpayer, for the spouse, any dependents, and one unique aspect is you can take medical expenses for people who would have been a dependent on your return. If we think back to the definition of qualifying relative, a lot of people were excluded because they had income higher than $4,050. That comes off the table for purposes of medical expense deduction. So again, we may not see this much in VITA, but it may just be helpful for people to know that if you pay medical expenses for an aging parent or someone else who would be a relative of yours but has more than $4,050, you can actually take that as a Schedule A itemized deduction. So if you're paying for someone else's medical costs, they could have been a dependent except they don't meet the gross income test, then you can actually deduct that on your return. Same thing if you have a person who would have been a dependent, but they're filing a joint return, or they're claimed as a dependent of someone else. So if you're a grandparent and you're paying medical costs for a grandchild, you theoretically can take their costs as a Schedule A itemized deduction. Again, we don't see that all that often within VITA, but it can happen. So what do we call unreimbursed medical costs? The main area, they have to be unreimbursed. So if you're getting reimbursed by an employer, if you're getting reimbursed by a flex spending account, a health savings account, that's not considered a unreimbursed amount anymore. What we're talking about are medical costs. So those are trips to the doctor. Those are going to be your pharmacy costs. Those are going to be anything that you go to the dentist, the eye doctor, glasses. All those types of things, if they're medically required, are considered a valid expense. Any prescribed medications and programs. So there's some real interesting areas. There's a table in Pub 17, Table 21-1, that gives a whole interesting list of things that have been claimed and things that are not allowed to be claimed as medical expenses. If a doctor prescribes trumpet lessons for an individual who has problems with breathing, that has been deducted as a medical expense in the past. Certain swimming equipment has been allowed because it's been prescribed. Again, it has to be a medically licensed professional. Having your pool guy tell you should get a pool put in is not a qualified medical deduction. So you can't just put a jacuzzi in your place because you get cold at night. You can't go to Arizona for the winter because you don't like the winters here in PA unless your doctor says you have to get out of certain conditions. Other things we want to take a look at, sometimes people may have special food requirements. They may have, maybe they have some gluten intolerance or maybe diabetes. Unfortunately, the cost of food, unless it's medically prescribed and have to be purchased through a program, are not deductible. So if they purchase food and they're getting gluten-free or they're getting low-carb or low-sugar food, we can't take the difference between them. So that doesn't quite count. And again, they have to be prescribed medication. So if you get a lot of spam email about getting your drugs a lot cheaper from Canada or Mexico, they don't count. They have to be here in the US from a licensed pharmacist. We do get to take an opportunity for any medical costs for if you're driving to appointments. We do see some people, generally what we're talking about with medical is these are major medical issues. So if you're driving to areas like Philadelphia, Baltimore for treatment, the medical costs for mileage would be deductible, and we have some travel expenses as well that could be deductible. But generally, we'll see that a little bit more in more unique situations. And F6 will give you a little bit more information on that. But again, just some tips when you go through itemized deductions, just sort of check with the taxpayer. Generally, home ownership is going to be our best way to see whether or not they're going to qualify. Again, you may get the person who comes in and says, I had a bad year medically. They have a couple $100s worth of expenses. They may bring you a listing of all their copays they had at the pharmacy. Some of the pharmacies are great. They'll now actually give you a printout at the end of the year to say, here's how much you paid us in copays or other amounts. So it makes it easy to total up those amounts. Sometimes you get people to come in and say, I gave a lot of money to charity. Every time the Girl Scouts ring my bell, I pay for an $8 box of cookies. I know the cookies aren't really worth $8. Can I take a deduction? No, you cannot. If you decided to pay $8 for the Thin Mints, enjoy the Thin Mints, because that's the benefit you're going to get out of it. But if people say, I gave $5 to a Race for Education, that's probably not going to get you an itemized deduction. You have to get over that standard amount. So just to kind of let you know, again, traditionally we'll probably see home ownership will be our biggest area there. So again, tax layer is going to I'm sorry, yes? Yeah, that's right. So if you're getting money out of an HSA account, so an HSA is designed for individuals that have a high deductible insurance plan. So you can put money in an HSA to be used for future medical costs. But if you're taking money out of an HSA to reimburse yourself for those medical costs, you have to reduce your qualified medical expenses for Schedule A purposes by the amount of the HSA distribution. So if you have $5,000 in medical costs, but you took $1,000 out of your HSA to help pay yourself back, your qualified expenses will only be $4,000. Yep. So it works the same way if you have a flex spending or if you get reimbursed by insurance or things along those lines. Yeah. Good question, though. Okay, so basically with itemized deductions, we're just going to simply determine whether or not they're in. If they're in, there may be a lot more questions you're going to ask, but generally we'll see a good amount of individuals, unless they have home ownership, probably taking the standard deduction. And that would allow us to populate it here. In our case, the Hess family is taking a standard deduction. From that, we'll subtract it from our adjusted gross income, then we'll take a look at our exemptions. So the exemptions are automatically calculating based on who we had put on the front page of the return, taxpayer, spouse, and dependents. So what we end up with is a taxable income of $3,177. We take a look at the tax schedule. TaxSlayer will automatically calculate that for us. They would owe $199 in taxes. The good news is this isn't the end of the story. We still have a couple more lines to go on the return. So what we can take a look at is the opportunity to have what we call non-refundable credits. So generally what we'll see in most cases within VITA, we'll hop right down to line 47, which is our tentative tax, and then we can take a look at these opportunities for what we call non-refundable tax credits. Generally what we'll see are one's going to be populating on lines 49 through 52, starting with the credit for child and dependent care expenses. So this is going to be found on G5 of your 4012 with some additional information. So the unique part about the child and dependent care expenses is anyone can take these as long as they meet the following conditions. There's no AGI phase out. So some of the other things that we're going to be talking about tonight are going to be phased out for higher income taxpayers. Things like student loan interest deduction, things like education credits will phase out based on your amount of adjusted gross income. Anyone in the U.S. can take the dependent care credit as long as they have earned income. So Bill Gates had a young child, and he and Melinda both had sufficient income. They can both be eligible for the child and dependent care credit. Somewhere between 20 and 35% of the costs that you incurred are a non-refundable credit. So what we're taking a look at is you get $3,000 for the first child, up to $6,000 if you have more than one child, which essentially means 2 children. So you can get up to $6,000. So again, the credit's going to range from 20% all the way up to 35% depending on your AGI. Good news is TaxSlayer will automatically calculate that for you. So the eligibility rules. What we're looking at is the care has to be for one of the following areas. First one is going to be child. And we thought we knew what the definition of child was for dependency exemption, right? Now we're going to change that. So it's basically, we're going to reference the dependency exemption and say the child has to be claimed as a dependent. If for some reason your child is in your custody, but your former spouse is claiming the child either due to a divorce agreement or some other type of arrangement, the custodial parent is one who's eligible to claim the child for child and dependent care purposes. Also for earned income credit purposes as well that we'll talk about at the end of the evening. But the child, in addition to having to be a dependent, has to be under the age of 13. So the IRS believes the magical age of 13, you no longer need someone to watch you. You are capable of raising yourself. I don't know if that's entirely true, but that's kind of how the IRS comes about it. Teenagers know everything. So once you turn 13, you no longer need someone to watch you after school or before school. Now, the nice part about it, all the other age requirements are just tested at the end of the year. For the child and dependent care credit, you're allowed to take any expenses up until the point the child reaches the age of 13. So if they turn 13 on December 1st, you can take all the expenses incurred from January 1 through November 30. So it's up until the time that they reach the age of 13. So the interesting part about what qualifies, it'd be any before school, any after school programs during the school year. It can actually be summer camps. If they're day camps, they qualify. Doesn't matter if it's soccer camp or Legos camp or Star Wars camp or whatever they want to get into, as long as it's not an overnight camp. So any day camps will qualify for child and dependent care purposes. The one thing we do want to watch is that we do need to have a Social Security number or EIN for any provider of childcare. So if someone's going to an after-school program at a church or at a rec center, they're very good about giving out their employer identification number. If they're having a neighbor down the street watch their kid after they get off the bus, that person may not freely give their Social Security number out. And the main reason, again, is because the IRS matching process. When we file the return to show that we're taking a child and dependent care credit, we need to put the provider and their Social Security number down. So what will happen is the IRS will take a look at the Social Security number and then go find that return and look for that individual to be reporting income from child care services. So if you have someone on the block who watches children as kind of an opportunity for someone to be able to come home from work and just know that someone's going to watch them, they may not give you the Social Security number, and we cannot take the child independent care credit if we don't have an EIN or a Social Security number. So that's something we'll need to have. So again, that's for children under the age of 13. If you have a dependent who is physically or mentally incapable of taking care of themselves, you can also take the child independent care credit. That dependent has to live with you for at least half the year in the home. This can also work if you have a spouse who's also mentally or physically incapable of taking care of themselves. And as long as they live with you for at least half the year, that will apply. So if you're married filing jointly, both spouses have to have earned income. Unless that spouse happens to be incapacitated, then they do not need to have earned income. So the deduction is going to be based on the lower of the $3,000 per dependent, the amount of earned income that you have, or the amount actually paid for childcare. So it's going to be the lowest of those three numbers. So all we have to do to fill out the child independent care credit is going to be on the form 2441. You do not have to memorize that. It's going to show up in your tax layer. And all we have to do is just enter the amount paid for each dependent and put in the individual responsible for providing care. And that will automatically calculate. What may happen in our case, in this area, you'll see that we have a child care receipt saying that we paid $800 for the care of Gavin for 2017. Fortunately, in this case, we'll see that we have the employer identification number, we have the name and address of the person providing care, and we know the amount of child care services. So we can enter that into the 2441. And you go through the process and you enter that in and you take a look at the return and you're like, it did not show up here. Why didn't it show up? The reason it didn't show up is because we're going to show you another credit next that's actually going to take precedent over the child independent care credit. This is kind of the beauty of, or the trick with non-refundable credits, is that they can only take your tax to zero. You don't get anything more. All we need is $199 of non-refundable credits and we've wiped out their tax liability. So one of the other ones we're going to take a look at is the education credit. And the education credit's one of our most powerful credits we're going to see, other than the one we're going to end the evening on. So we'll have a grand finale here of the most powerful credit possible. But the education credit's a pretty close second. So the education credit, which you'll have information on J4 to J5, is dealing with individuals who are in school. We have two different credits available. One's the American Opportunity Credit. The other one's going to be the Lifetime Learning Credit. Both kind of start with a very similar base. They're going to be based on either the taxpayer, the spouse, and or dependents who are claimed on the return who actually attended an eligible post-secondary institution. So you cannot be claimed as a dependent on another return and take the credits. Also, you cannot be filing separately while you're married and take the education credits. So we may see this one or two more times about the detriments of married filing separately. So what do we mean by qualifying expenses? This is going back to almost our tuition and fee definition. It's going to be our qualifying tuition costs. That's the amount actually paid to the school for the tuition itself. Any related fees, any kind of required fees for attendance. So anyone who's in school or anyone takes a look at a bursar statement, you'll see in addition to tuition, now they start adding in all these other fees. Student activity fee, technology fee, recreational fee, fee to keep the leaves off the sidewalk so we don't slip and fall fee. They'll add up. They're almost like $1,000 per semester now when we take a look at some of these fees. Fee for new student orientation. So when they take you out for pizza and explain what it's like to go to college, they charge you for that. But if they're a required fee, if they're not an optional fee, that is part of the tuition fee opportunity. What doesn't count is going to be room and board again. So again, everyone needs to eat and sleep, so room and board is not an eligible expense for purposes of the education credit. Again, neither are the living expenses. So if you go to the college bookstore and you load up on all the school emblem wear, so when you show up to class, you can show that you have your school spirit by wearing the t-shirts and sweatshirts and everything else, that is a personal expense. Unfortunately, it does not count for purposes of tuition and fee deduction. So what we're looking at again, tuition and related expenses. Books do count. So any books that you have to purchase for purposes of the credit would count. There's going to be a slight change in how we handle that for the American Opportunity versus the Lifetime Learning. But books will count in full for the American Opportunity. We'll have a slight change once we talk about that Lifetime Learning. So the most powerful one we're going to talk about is that American Opportunity Credit. This is eligible for students who are in the first 4 years of post-secondary education. They do not have to be consecutive. If someone went out and they got an associate's degree and then went back to finish off their bachelor's degree, they're still in the first 4 years of post-secondary education. So as long as they have not completed the first 4 years, they are theoretically eligible for the American Opportunity Credit. Nice part about this credit is we only need $4,000 of eligible expenses to maximize the credit. We can take up to a $2,500 credit based on $4,000 worth of expenses. And again, we're using the exact same base we do for the tuition and fee deduction. Tuition and fee, our benefit is maybe $400. This could be a maximum of $2,500, so this one's much more powerful. In addition to the $2,500 credit, 40% of that's fully refundable. So if you maximize out your credit, you can get $1,000 back even if you have no tax liability. So that's one of the things we take a look at here to see how important this credit is. Again, what we're looking at are tuition, fees, materials, other related costs, any books, any other supplies. If you have to buy them for school, they count. You have to be enrolled in a program that is leading to a degree or certification, and you have to be at least 50% student, which will indicate on the Form 1098-T. One area, which is always kind of unique, but you have to ask, is have you been convicted of a drug charge for felony purposes? So are you a convicted drug felon? Any other felony is fine. Again, we're not quite sure where in Congress someone got the belief that there are too many drug felons out there trying to go to college and become educated. We don't want that. So if you have a conviction, not just charged, if you were charged and you pleaded down to a misdemeanor, you're okay. If you got off because you had a great attorney, you don't have to disclose that. It's only if you are a convicted drug felon are you ineligible for this credit. You do have to ask, which is kind of odd. But any other felony's fine. Racketeering, extortion, murder, kidnapping, you're okay. You can go to college and they'll give you the full credit. But a felony drug conviction does not work. So yes, sir.
Is that a lifetime?
Yes. That's at this point a lifetime. So I guess the question could be if you get pardoned or expunged, maybe you could go ahead and qualify for it. But it is a lifetime ban on felony drug conviction. So we'll see what happens over time if that stance softens at all. But right now it is a lifetime restriction. So as long as you're not a felony drug situation, as long as you're at least a half-time student, if you have $4,000 of qualifying expenses, which in today's day and age, 4,000 is not a hard number to get to in college, to be a half-time student, you can qualify. The other interesting wrinkle we have is that what we're looking at is when was the tuition paid, not when it was billed. So part of the problem we can sometimes run into with the American Opportunity Credit is a traditional student matriculation. You will go into school in the fall of a semester, and you graduate 5 calendar years essentially from then. But you're only in there, the credit allows 4 years. So one of the things we take a look at is when do you typically pay that spring tuition? If you're billed for tuition, and usually the schools are very good about sending you the notice, oh, by the way, you're enrolled, you owe us some money. So most people, if you're in school now, or if you have a student in school, you're probably getting that tuition bill to say, by the way, we'd like you to pay for next semester. If you pay in a calendar year, and that student is going to be enrolled in an institution in any of the next 3 months, you can actually take that deduction in the year paid. So if in 2017 you're prepaying for spring of 2018, you can use those expenses in 2017 to take the credit. So the nice part about that is it gives you 3 months. Most schools have everyone go back in month 1. If you're on some sort of alternative method to go back to school and you're in some sort of cohort or other type of quarter or trimester system, as long as it's within the first 3 months, you're all right. What this hopefully alleviates is the problem that you have 5 years of undergraduate education and you're trying to get a 4-year credit in that period of time. So the credit's only good for the first 4 years. The IRS is very good at catching up to see if you try to claim this for more than 4 years for the same student. And unfortunately, I've seen some situations where taxpayers continue to file the credit as long as the child's still in undergraduate education. Once you exhaust the 4 years, you can no longer take the credit, at least from an American Opportunity. If they don't qualify for the American Opportunity, they can take a look at the lifetime learning. That's a little bit of a different credit. That's also non-refundable, but the credit's 20% of your eligible expenses up to $10,000. So you can get up to a $2,000 credit, but it's 20% of each dollar up to $10,000 to get you your maximum. There's no limit as to how many years you can claim this. So if you want to go back and get a second bachelor's, 3 master's degrees, and a PhD, you can take all of those for every year you're in school. You don't even have to be in a full-time position. You can take this as less than full-time. So if you want to enroll in a planetarium or a philosophy course at F&M, that qualifies. All you need is to take is one course, and the tuition that you pay would be eligible for the lifetime learning credit. Any books that you purchase, as long as you buy them through the bookstore, would also qualify in any of those related expenses. You can also be a convicted drug felon. So if you ask someone and they say, I'm sorry, I can't take it, you say, well, we have this other one available for you. It's not as good, but at least you still have the opportunity. So that might be the reason why Congress may never change it, because they say we have an alternative. Not nearly as good as the first one, but there is an option. All right, so that's basically what we take a look at. Yes, ma'am?
So if someone's on a 6-year plan or even 5-year, they've gone through the 4 years of American, they can, for the 5th year, move down to the other.
That's correct. Yeah, you can move down to that, and then you can take that for as long as you're still in school. And it kind of works out well for people who might be on maybe a different path. Maybe they're doing some evening programs to finish off a bachelor's degree. If they've already exhausted 4 years, they can use the lifetime learning. Absolutely. One of the things we're typically going to see, the way that we trigger this, is we're generally going to get a Form 1098-T from the qualified institution. The IRS realizes that this is a very, very powerful credit. And they also realize that if you call up a college and say, I would like to get your employer identification number for tax purposes, most colleges will give it to you. Or they have it on their website to say, by the way, our EIN is this. So it's very easy for people in the past to say, oh, by the way, I'll just take an education credit. For 4 years, I can get $2,500 off my taxes. Just by saying, oh yes, I went to Hack or I went to Millersville. And no one ever checked it until the IRS realized maybe we should check it. So they require a little bit more substantial documentation now. So in order to complete the education credit, we have to file the Form 8863. It's a fairly easy form to go through in TaxSlayer. We're going to get most of that information off the Form 1098-T, which will be coming from the institution. Now, sorry about that. One of the things we'll see here with the 1098-T is that we'll have a lot of pieces of information. One will be the name and address of the education institution. So we do need that in order to complete the 8863. We do need the employer identification number for the institution. Some other pieces we're going to get here are knowing whether or not the student was at least a half-time student. That's actually checked in box 8. So it gives you an indication that they are meeting at least a requirement for a half-time load, which will put you in American Opportunity. There's also a box down there that says if they're a graduate student. So if the institution is checking off that they're a graduate student, it means they're already beyond the first 4 years of post-secondary education. Some things that we want to watch is that the 1098-T may be a great form to get us started. It may not give us all the information we need. So in this example, we're actually showing an amount in box 1. Most institutions that I've seen never put anything in box 1. They're always going to show it in box 2, which is the amount that they're billing. But what we can take a look at is to say, well, how much did someone pay in that current year? If someone is getting credit for tuition and is being offset by a non-taxable source, like tuition reduction or a scholarship or some sort of fellowship, any scholarships or grants generally show up in box 5. So those would reduce the amount of eligible expenses. If we have a situation where someone is showing that they were going off to Princeton and they're paying $50,000 a year in tuition and they got a $5,000 scholarship, I probably don't need to do a whole lot of other digging to know that they're probably over $4,000 out of pocket. And $4,000 out of pocket is whether you pay by cash, credit card, or loan. It doesn't matter how you pay for it. So we need to go ahead and take a look and see, are there any reductions that we need to make? So if there's any credits that they're getting from the school, any scholarships, any grants, if they're using 529 funds, the earnings from those funds do not allow us to take those as qualified costs. So sometimes we may need to get a burster statement. So hopefully someone can either have access to their burster statement, which shows all the detail. So the school may show something in box 2, which is amount billed, but we really want to focus on the amounts actually paid. And so hopefully they can bring a burster statement in to show how much they actually paid. If they don't have it, generally can get it online fairly quickly, so maybe you can help them pull up that information. So we just want to watch it, we're taking the full amount. As long as they're over $4,000, we're in good shape. Again, we're going to take their word on how much they have. It's going to be up to them to show to the IRS in case there is any type of examination. But what we're going to take a look at in this case, we have $12,000 reported as amount paid. $5,000 of that was scholarships or grants. So we have $7,000 of eligible costs. So $7,000 is what we'd use for the credit purpose. Because we're taking the American Opportunity Credit, we're going to be able to take the full $2,500 credit, $1,500 of which is going to be shown as non-refundable, because that takes preference over the Child and Dependent Care Credit. That's where the $199 comes in, and we've completely wiped out our tax. The remaining amount, we'll see that gets picked up in a little bit. All right, before we head into the final two, how about if we take a 5-minute break, let everyone kind of get recaffeinated, rehydrated, and all set for the final pieces. Great, so one of the other credits we see that's generally going to be an automatic credit is this concept of the Retirement Savers Contribution Credit. What will traditionally happen with this credit is it will automatically calculate based on our inputs from a W-2. The credit is going to be based on any voluntary contributions made to a qualified retirement plan. And the credit can range anywhere from 10 to 50% of eligible contributions. Now, this is based on an AGI phase-out, with TaxSlayer will go ahead and calculate that. A lot of the other things we had talked about tonight, most of our VITA clients don't run into the problems. They're going to be under the threshold for student loan interest for the most part. They'll definitely be under the thresholds for the education credits. But the problem that we run into with the Retirement Savers Credit is going to depend on what their AGI is. And we can run into some situations, particularly with single individuals, that their AGI, their gross income, may be too high to take the Retirement Savers Credit. But this is predominantly going to be automatically calculated. What we can take a look at is if it's coming off a elective deferral, and this is kind of our second dash on the slide. If we have elective deferrals to a 401k, a 403b, a government 457, a SEP or a simple plan, these will all be listed for you in the W-2. They're all going to be shown in box 12 with a code. It's going to sound like Sesame Street here, but we're going to looking at a D, an E, an F, an H, an S, a double A, or a double B. So those would all be indicating that someone has made an elective voluntary contribution to a retirement plan. TaxSlayer will automatically calculate any available credit based on those entries when you put the W-2 in. So for most of us, that's all we need to do. Now, the one other element we have that you can take the Retirement Savers Credit on is any contributions to an IRA or Roth IRA. Now, the Roth and regular IRA we don't show on the W-2. Those are individual contributions. So a taxpayer may bring in a form 5498. You don't need to memorize any of these forms, but you may want to ask, did you make a contribution to an IRA or Roth IRA? So the question was asked tonight about, when does the taxpayer make that contribution? If they come in early, do we just indicate that they should make that contribution by the due date? The interesting part with a traditional IRA is you can actually double dip. You can take a deduction for the IRA on the adjustment part of your return and take a credit on those exact same dollars. The IRS generally does not allow that to happen, but this is one situation where you can actually take a deduction and a credit for the exact same dollar amount. So in some cases, we've actually seen taxpayers that if they know they're going to get a refund, they can actually take the refund and put it into their retirement account. So you're basically having the government help subsidize your own retirement. Again, we probably don't have a whole lot of time with VITA to do tax planning for clients, but if they bring up the idea that they'd like to make a contribution to a traditional IRA, they can get the benefit of the IRA deduction and the possible contribution to a retirement plan for the Retirement Savers Credit. Again, these have to be voluntary contributions. If the employer is making the contribution on your behalf, whether it's from a profit sharing or an employer match, or it's a defined benefit plan, those are not voluntary contributions. They have to be taken out of the employer's or the employee's pay by the employer's employee's direction. Sorry, a lot of E's and R's. But the employee has to voluntarily defer money to be eligible for the credit. A couple other plans that we will not even get into, 4974C or 501C18D. If you have to ask what these plans are, the person you're going to ask has no idea if they participate in them, so we don't really need to worry about them for purposes of VITA. So when we take a look at that retirement savers credit, what are we looking at? Well, the credit's actually based on contributions up to $2,000, and I apologize, so the slide in the Prezi doesn't quite match up, but you do have the correct slide in your materials. So the credit's based on a $2,000 per taxpayer maximum contribution. Now, the government doesn't do credits without a few wrinkles in here. So one of the wrinkles they have with the retirement savers credit, and one area that we may need to ask, mainly because we no longer have the history of all the years because we changed tax programs last year, is if the taxpayer had a withdrawal from a retirement plan in 2015, 2016, 2017, or 2018 up until the due date of the return, that has to be calculated in for the retirement savers credit. So there are a couple exceptions. If that distribution was due to military withdrawal, if it was due to a withdrawal mandated by a inheritance, those do not count against you. But the government doesn't want you to take money out of your IRA one year and put it back into your account the next year and essentially have the government help subsidize your contribution. So we have to take a look and just ask. In most cases, what we have is we already have 2016's information either in TaxSlayer from the year before if they're returning, or they're bringing their return in for us to take a look at it. So generally, we just have to ask, did you have anything in 2015? Do you anticipate taking any contributions out of your retirement account before you file your return? The answer is no, then we can simply go along with that credit. Again, the AGI phase-outs are relatively low for this. For single individuals, it's $31,000. So we do have quite a bit of a gap between eligible income and AGI phase-out. So not everyone will qualify for this. However, the married filing jointly is $62,000. So usually our married couples will be able to fit into that opportunity. Head of household is about in the middle of that. It's $46,500 when that phase-out starts kicking in. Again, TaxSlayer will automatically calculate this for you, and probably one of the few credits other than the next one we'll talk about that requires very little input from us. A lot of these times when we see them, it's because a individual is participating in their employer retirement plan, and that'll be shown on the W-2 with any of those codes that we had mentioned. One other little area, this does not apply if you are a student. So if you're a student, you cannot get a retirement savers credit. If you're claimed as a dependent, this doesn't work either. And if you're born after January 1st, 2000, it does not work. If you're born on January 1st, 2000, and you're not a student and not a dependent, that somehow you're a 17-year-old who is completely emancipated and not going to school and has no eligibility to be claimed as a dependent, you may take that. So anyone born after New Year's Day on 2000 may not take this. And that one's, again, a fairly routine one that we are generally going to see automatically calculate. And again, this is a non-refundable, so it won't always show up on everyone's return. So if they have already eliminated all of their possible tax, they will not get the retirement savers credit. And if you need more information on that, that is on the G9 of your 4012. So in this case, we can see we've already exhausted all of our possible non-refundable credits, so the ones that we're going to be talking about will not populate in your example of the HEST return. When we go through some more practice returns, you will actually start seeing more benefit of these non-refundable credits. The last one we're going to talk about in the non-refundable piece is what we call the child tax credit. This, again, is automatically going to calculate for you. This is probably our easiest one. We don't have to do a thing with this. All we do is we enter the dependent information in on the first screen. What will happen is we get the maximum of $1,000 per qualifying child. And what do we mean by qualifying child? Well, one of the things we have to take a look at is claimed as a dependent. But we're changing the definition of child yet again. So we already have to be a qualifying child, but now we're going to change the age. They have to be under the age of 17. So once they turn 17, they're no longer eligible for the credit. So anyone born in the year 2000, last year was a great year for you. That was the last year you could take the credit for them. Once they turn 17, they're no longer eligible for that child tax credit. So I'm not sure what congressman thought at the age of 13 you can manage yourself. You don't need someone watching you after school. You're a teenager, you're good to go. Once you get your driver's license, you no longer need any financial assistance. You're fine. You don't cost your parents any more money because you're not eating, you're not getting more clothing, you don't have car insurance or car payments. You don't need the additional $1,000 per family. So you usually have kind of a gap year or two where the child has come out through the system. Once they turn 17, they don't get that $1,000 credit. That may be their senior year of high school before they go off to college. So you get a nice break the next year, the $2,500 American Opportunity Credit. You got $1,000 while they were still 16. That year they turn 17, they cost you more money. So that's kind of how the IRS works. So they have to be under the age of 17. So it doesn't matter, this isn't like the Child Independent Care Credit. If they turn 17 during the year, they're ineligible for the credit. That's going to automatically be based on the birth date that we're inputting in on the first part of the return. So this is going to be based on whether or not there's a dependency exemption on your return. So a non-custodial parent is going to be eligible to take the dependency exemption and the child tax credit. That's all a non-custodial parent can take. Everything else is based on where the child resides for more than half the year. So that child independent care credit is based on the custodial parent. The earned income credit that we talk about will be based on the child's custodial parent, not on who takes it as a dependency exemption. So if you have a situation where a taxpayer is divorced or no longer living with their spouse, and they're taking the child as a dependent, which they're allowed to do, particularly if they have a signed 8332, which is a divorce agreement, which says a non-custodial parent may claim the child, they can take them for dependency purposes and child tax credit purposes only. And you don't have to memorize that because TaxSlayer will go ahead and do that for you. But a custodial parent is the one eligible to take a child care credit and also have that child as a dependent for purposes of earned income credit. So once you put that, oh, I'm sorry, Howard, yeah.
You're filing Form 8332, now I guess you have to do a paper training, so form that to sign and mail in.
That is correct, yeah. If and there is an option we have. You can actually still electronically file the return, but it converts it from the 8879 to an 8453, which the taxpayer signs, then we just mail that with any documents to the IRS. So you can still electronically file, and I believe TaxSlayer will allow you to convert that e-file to an e-file kind of cover sheet that then goes to the IRS. Right, so that's the 8332 is kind of our protection form for non-custodial parents. If you're in a divorce situation and your divorce agreement says that you're allowed to claim the children, you better have a copy of the 8332 which protects your interest. Because the IRS will default, if both parents try and claim the child, they'll go with whoever the child lived with for more than half the year. So the custodial parent usually always wins out in a situation where both parents claim. The IRS will not abide by a divorce decree. Doesn't matter what the divorce decree says, the IRS will follow who has custody. So they'll go back to those tie-breaking rules we had talked about with dependency exemption. So if you do have a client that says, I have a child, I'm allowed to claim them for 2017, here's my 8332. As Howard mentioned, we do have the ability to claim them as a dependency. That'll trigger the child tax credit. And to protect their interests, they may want to send that form into the IRS, just to make sure that it's audit-proof at that point. Yes, sir?
Child tax credit and the dependency credit has to be the same.
That is correct, right? They cannot be split. So dependency and child tax follow each other. Yep. And that would go to, I'm sorry?
EIC also?
No, EIC is going to go with the custodial parent. So the non-custodial may take a dependency exemption and child tax credit only. They can't take the child care credit because they're not custodial. They cannot take the EIC because they don't have the child for more than half the year.
But the custodial care, even though they gave up the dependency, can claim EIC.
That is correct. They can claim EIC and they can take the dependent care credit as well. Yep. Yep. So there's some unique aspects there that can arise. We don't often see that within VITA, although Howard, sounds like you may have some non-custodials that you work with. No. Okay. All right. Okay, perfect. All right. So if the situation arises, ask Howard or ask myself on what to do with non-custodial parents. So I think we've got it. All right. The nice part about the child tax credit, in addition to us not really having to do much with it other than enter the information in as a dependency, is if we don't get full benefit for the non-refundable piece, this can actually convert itself to a refundable credit, which is called the additional child tax credit. Again, creative naming from the IRS. If you don't get the first one, they'll call it an additional child tax credit. Doesn't mean you have additional children, it just means that it will convert to a refundable piece. So if you don't get full benefit of the non-refundable, if you meet certain conditions, it may become a refundable child tax credit. So you have to have earned income over $3,000. And again, the system will automatically calculate. You don't need to worry about the minutia of the details. You don't have to get fully into the sausage-making process to understand how it works. The system will automatically calculate. It's based on how much earned income they have and how much credit was not used as a non-refundable piece. So portions that we talked about here, the American Opportunity Credit and Child Tax Credit, are traditionally non-refundable, but they can become refundable if certain conditions arise. So what we're going to see in our case here is that we do not get any benefit for the child tax credit because we've used up all our non-refundable credits already. We've eliminated the $199 of tax. So we see that we have $199 of credit, which completely offsets our tax. So we can't take any more than that. The rest is non-refundable. So we have a zero tax balance. Now what's nice is we don't owe any money to the government, but we did pay money in. If we take a look at the information we've input already, we actually had federal income taxes withheld from our W-2 and 1099. So that was $3,526. So that amount will be eligible for a refund. Also, we may have the opportunity for some of these refundable credits. The biggest one that we'll see, the one we're going to end the evening on, the most powerful credit, the earned income credit. So this is a refundable credit for individuals who work, but they don't have high income. It's actually an incentive for people to go out in the workforce and try and make sure that they can have earned income to provide for themselves and their family. So the qualifications, you must have earned income. And what we mean by earned income is traditionally wages, self-employment income. On some exceptions, we can have long-term disability payments if you're collecting those before you reach retirement age. Those can be considered earned income elements. As long as your investment income, essentially interest and dividends and some of your capital gains, are not more than $3,400, which is generally not a problem within VITA. Again, to get $3,400 of interest income, you need approximately $1.7 million in the bank for the entire year to collect $3,400 worth of interest. So generally not an issue here in VITA. Another caveat, filing status. Probably know where this is going. You cannot be married filing separately and take the earned income credit. So there may be situations where people say, I do not want to file with my spouse, I don't trust them, I don't want to be in the same room with them, I'm going to file married filing separately until you get to the return and you say, by the way, do you realize that you can't take the student interest deduction, you can't take the American Opportunity Credit, you may have to file itemized deductions because your spouse has a home, and you don't get the earned income credit. And again, we talked about some solutions. We can still file a joint return. We have innocent spouse provisions. We have injured spouse provisions. We can even set it up that they come in at different times to sign the 8879 if you like. They don't have to be in the same room. They just both have to review the return. So a lot of reasons why married filing separately is not a great status. Earned income credit is probably one of them. We do need to have a social security number for every individual on the return. Taxpayer, spouse, and all dependents have to have a social security number. They cannot have a temporary number. It has to be an actual social security number. You can't be dependent on someone else's return and take the earned income credit. Also, if, similar to the American Opportunity Credit, the IRS realized there were a lot of people who tried to take the earned income credit and weren't entitled to it. So if you've been barred from the IRS from taking the earned income credit, you're not allowed to take it in a subsequent year. Generally, that's only for purposes of intentional disregard for the rules. They can ban you for life. If it's an oversight, then it's only a temporary suspension, and then you're allowed to take it again. But usually the taxpayer will know. It'll be flagged. We can't actually electronically file a return if they've been permanently banned and trying to claim the EIC. Now, what we take a look at is the way to maximize the credit is by having children. Not to encourage everyone to go out and just start having kids to get benefit of the earned income credit, but if you have them already, use them to your advantage. Because what we'll take a look at is how the credit's going to come into play. What we're going to take a look at is qualifying children will help boost your amount of earned income credit. They're going to be very similar to the dependency rules, except, as kind of I guess that's going to be our word for the evening, right? Except for changes in definition. So it's going to be the same thing as our dependency exemption, except you don't have to worry about the support test. Support test for a qualifying child meant that they could not have provided more than half their own support. Again, not that we see this very often in VITA, but if you have a situation where a child's providing more than half their support, whether it's from earnings or maybe it's from Social Security benefits that they're receiving used for their own support, they can still be dependent for EIC purposes. The support test now comes off. They can provide more than half their support. The other issue that we see is that they have to meet the residency test. They have to be with the taxpayer for more than half the year, which is why we can see a change in dependency exemption. So even though you don't have a dependent on the front page of your return, if they've gone to the non-custodial parent, they have to be the dependent of the custodial parent for EIC purposes. So even if you don't have the child on your return because you've given them to your ex-spouse for that year for dependency, if they lived with you for more than half the year, they can still be your dependent for earned income credit. So you can split that off the dependency. So just one thing to keep in mind when we take a look at the earned income credit. And so why are we talking about children? Well, if we take a look at the earned income credit, again, we need to have taxable income, we need to have earned income from wages, self-employment income, or early disability payments. So if we don't have any children, we have some very narrow limitations. So first of all, now we're going to have an age restriction. You have to be between the ages of 25 and 65 if you do not have any qualifying dependent children. Meaning that you cannot be over the age of 65, so if you're essentially in a retirement situation and you have a part-time job, you are not eligible for earned income credit unless you have a qualifying child. If you're under the age of 25 and you don't have a child, your wages that you work part-time or even full-time do not give you an earned income credit. You have to be between 25 and 65. Even with that, we have to have earned income of less than $14,880, and this is based on single rates. Do not memorize these charts, it's just to kind of give you some illustration. So if we don't have a child, you have to have less than $15,000 of earned income, which is essentially a part-time position. And your credit is about $500 maximized. So not a great benefit. Still a nice one, but not a great benefit. Let's start adding some kids in the picture. So as soon as you add one child, a qualifying child, now we take the age restriction off. So if you're 96 years old and working a part-time job and you have a 3-year-old running around the house, that's your child, you can take the earned income credit. In fact, you probably want to have a break from the kid and work part-time to be able to afford diapers and everything. But now what we've done is we've changed that. We've gone from about $15,000 before we phase out of the credit up to almost $40,000. So now we've gone up to almost $40,000 of earned income before you lose the credit. And the credit's gone from about $500 up to over $3,300. And now we can keep adding more kids. We add the second kid on there. Now we've gone up to almost $45,000 of earned income. And the credit has gone up to over $5,500 of a credit. And once you add the third kid, stop, you don't need any more kids. We only go up to 3. So not to advocate, selling off the other kids' Social Security numbers if you have 11 kids, see how much you can get for the other 8. But you only need 3. That's all we need. That maximizes out the credit. That'll get us up to almost our full level of $48,000 of earned income for a single individual. And the credit goes up to almost $6,300. So you can see just how powerful this credit becomes. Starting off at $500 and all the way up to almost $6,300 if you have 3 children. The best part about it, it is fully refundable. So even if you have no tax liability, you will get all this money back. So those are some things we'll take a look at. If we take a look at the return, once we populate the earned income credit, in this case, based on the taxpayer's children's status and their earned income, they got an EIC of $3,800. So in addition to all their withholding, they got more than that back in the earned income credit. They're also going to get $1,000 from the American Opportunity Credit, which became refundable. They're also going to get $1,000 of refundable additional child tax credit, both of which will be automatically calculated from TaxSlayer. Everything we see in lines 64 through 73 will be automatically calculated by TaxSlayer. So what we're going to see in this case, they're actually going to get a refund of $9,364, which can come back to them in the form of a check. If it's direct deposited, 10 to 14 days, it should be in their bank account, as long as they file after February 1st. So this is the power of VITA. This is where we see the benefit, because we're going to have people come in and actually get refunds based on their tax situation. Yes?
For the EIC,
Yeah.
does that age, like 65, does that matter if you have kids or does it mean?
The age is only if you do not have children. So if you have children, you can be under the age of 25, you can be over 65, and that would take basically the age test out of that equation. Yep. So that's only if you have no children does the age test come into play. So this is really kind of the exciting part about VITA, is when you get to meet with a client, and they usually come in, they're not entirely sure how to file their own return, there are a lot of questions, and they don't know what to expect. And particularly if it's the first year and you can show them that they're going to get a refund of $9,364 based on their filing status. That's really what will make your day. That's why we're here. When you go through the process, there may be questions you have. That's fine. Ask. Go ahead and use your resources. Ask your site coordinator. Slow down if you have questions. We can always come back and help them out. But this is really what's exciting, when you can take a look at someone sitting across the table from you, watching you spend about the last 45 minutes asking them questions and typing information in the return, and you tell them you're going to get a check for $9,364. Yes?
Might be worth mentioning that there's a little more information that's on this chart, but these numbers really reflect much lower
Yes.
earnings than we have with the year. You can still make $47,000. You can get EIC, but it's nothing like $6,200. You're down to almost nothing.
Right. Yeah, so the EIC is going to slide based on your filing status and based on your income. So this is kind of taking a look at the...
$15,000 in that range to get these kind of numbers.
Right, yeah, so that'll depend on how much income they have, and usually most of our clients are probably going to be based on their wage income, so there's not a whole lot of option we have with that. Yeah, so this is just kind of for illustration purposes, just to show what it could be, not exactly what it always will be based on those charts. Yep, yep. So those will change, and they can change from year to year based on individual circumstance. Yep. Yes, sir.
So I'm doing a FAFSA for this kid of mine today. So I had to have her bring in, she's a graduate, I had to have her bring in her month's
Sure.
2016 taxes. And the person who did her taxes had a mom file as single, and I know she's got 2 kids. And she made, I think, $1,600. So she could have gotten her an income credit, she could have claimed
Right.
the head of household.
Yep.
Can we redo that?
Sure.
Even though it's 2016 taxes?
Yeah, you can go back and amend returns, and we may actually see that, particularly if you have people come in and maybe they prepare the return themselves, or they went to another place to have their return done. Now, in her case, probably with that low of income, maybe the head of household may not have made much of a difference because it probably already wiped out her income. But yeah, certainly we could go back and put that in. You know, if you see that, oh, by the way, we can take an itemized deduction here for your 2017, you haven't taken it in the past, we can go back and do amended returns. If people have missed credit opportunities because of earned income credit or American Opportunity or other things, we can certainly go back and amend.
So she just needs to call 211, make an appointment,
Yeah.
and let them know she's also bringing in 2016 tax.
Yeah, absolutely. So that'll allow them to go back and file and get more money. And this is what's really exciting, because those types of situations where you have a person with only $16,000 and a couple kids, that's significant money. That can pay rent for a couple months. That can go ahead and get a car to get to work instead of taking the bus. That can allow them to put money aside for health issues or education savings. And that's really what the benefit is. Yeah. Yeah. Yep, absolutely. Yeah. So, and that's kind of a great way why we have them bring in the prior year return, so it gives you a guide to work with. But you can also take a look and say, wait a minute, something, our year is so much different than what your prior year was. Maybe we should go back and take a look there. Absolutely. Great. Yes, sir.
So this, again, my date, my insurance, about the maximum credits I'm having.
Sure.
But I mean, it's a generous credit, generous credits and all that, but she also, the person had $3,500 taken out in taxes.
Yep.
That they really didn't have to.
Correct. Yeah, and that might be a good planning point. Sometimes our clients like to get a big check, but they could have had more money throughout the entire year if they had not had so much withheld. So if you think about it, they probably would have had $300 more per month to work with if they did not have so much in withholding. So $300 a month could have probably helped them out more so throughout the year rather than getting one big check. Right, and it's an interest-free from the government. So you're hoping the clients don't take this and say, hey, great, Best Buy's having a sale on flat screen TVs, now I can get the one I always have my eye on. Hopefully they're going to use that for better purposes, but at least we're getting them the money that they are entitled to. Great. Any questions on kind of the return? So even though Ezra said we're going to be here for a while, we covered a page and a half of the 1040 in less than 2 hours. So, but this is the exciting night. This is the night that we actually get to complete everything together, show the credit, show the deductions, and show how much the taxpayer hopefully will get back. And if they don't get anything back, we'll show you where the Kleenexes are at your site. So if anyone is owing, we'll talk about that. So next week, we'll talk about the Affordable Care Act, how do we deal with the medical insurance, and also some state and local issues.
Next week's just advanced.
Next week is going to be for all participants. The week after that will be for advanced, the people going for advanced certification. Okay, and I'll double check with Ezra on that, but I think that's how we typically go is ACA and then state, and then we'll do the advanced the week after that. All right, so thank you very much for your time and attention this evening. Hopefully everyone had a great Thanksgiving, and hopefully we'll see everyone back on next Thursday.